Welcome to the deep dive. If you've been watching the charts, you know the atmosphere right now. It's thick with anxiety. It is November 7th, 2025.
Yeah, and the data, well, it paints a picture of market distress, far greater than I think many were willing to admit even, 2 weeks ago?
Definitely. We are squarely in one of the most tumultuous periods the crypto market has faced this year. It feels pretty rough out there.
That's absolutely correct. When we look at the source material for context, the headline figure is, well, stunning. The total market capitalization of all cryptocurrencies. It's plummeted by over $1 trillion.
A trillion.
Since when? Since the beginning of October. That sustained sell-off has effectively wiped out nearly all of the gains the market fought so hard to establish this year.
Wow. So where does that leave us year to date?
We are now hovering barely positive, sitting around only 2.5% up year to date, almost back to square one for 2025.
And the gravity of that drop is best illustrated by Bitcoin itself, right? The whole system seems to be struggling just to hold on to that critical, highly psychological $100,000 level.
It is. And that's why our mission today, our deep dive here, is really an exploration of these stress fracture points. We have to address two parallel crises, essentially.
Oh, two crises. What are they?
First, we need to understand the powerful, systemic, macroeconomic forces, you could call it the external gravity, that are driving this market-wide crash, the big picture stuff.
Right.
Second, we must narrow our focus to a specific project, the Pi network. Our data shows it's declining far harder than the larger, more established assets like Bitcoin or Ethereum.
So the listener needs to walk away understanding both the forest, the whole market mess, and this one deeply distressed tree, the Pi situation.
Exactly. You need both perspectives to really grasp what's happening.
Okay, let's unpack that global financial weather pattern first, because like you said, to understand why something like Pi Network is down, what is it, 13% this week?
Yeah, around 13.3%.
We have to first understand why Bitcoin itself is down 6%. So the source material identifies 5 major forces driving this widespread sell-off. Let's start with the big one, the entity that controls the cost of money globally, the Federal Reserve. What message has the Fed been sending since, say, early October?
The Federal Reserve, guided by Chair Jerome Powell, adopted a profoundly hawkish stance in late September and early October.
Hawkish meaning?
Hawkish in this context means the Fed is prioritizing fighting inflation and maintaining monetary tightness over, stimulating growth. Powell explicitly signaled that the previous round of interest rate cuts might be the last we see for the remainder of 2025.
So basically throwing cold water on expectations of further easing?
Pretty much, yeah. A real dampener.
And we know the crypto market, despite its whole decentralized philosophy, it reacts immediately and dramatically to centralized financial policy like that. How did this signaling change the future outlook, like in terms of numbers?
We can actually quantify the market's expectation shift if you look at the CME FedWatch tool.
Right, that tracks futures contracts on the Fed funds rate, shows where traders expect rates to go.
Exactly. Following Powell's statements, the probability of a December rate cut, which the market had almost taken as a given, it was like 96% probability before.
96%, okay.
Yeah, it dropped precipitously, down to just 69.3%.
That's a massive drop, almost 30 points.
Huge. It signaled a deep shift in sentiment. The market suddenly priced in an expensive cost of capital for the foreseeable future. No more easy money expected soon.
Okay, so if the cost of money is expensive, why should an institutional investor pull their money out of something like Bitcoin? I mean, it still offers potentially massive upside, doesn't it?
It does, potentially. But it comes down to risk-adjusted returns and capital rotation. When interest rates are high, two things happen.
Yep.
First, it makes borrowing capital costlier.
Yeah.
That chokes off funds that might otherwise flow into speculative assets, like crypto.
Makes sense. Second,
and this is crucial for large institutions, higher rates mean higher yields on safe assets. Think government bonds.
the safe haven play.
Exactly. Why take a massive risk on volatile crypto, which the market definitely classifies as a risk-on asset, when you can secure, say, 5% or 6% returns virtually risk-free in bonds?
Right. Institutions have mandates, fiduciary duties. They'll take the safer bet if it's decent.
Precisely. So they rotate out of crypto and into fixed income. And we saw this correlation instantly play out. Bitcoin dropped 1.6%, and Ethereum fell 2% within just 24 hours of that renewed hawkishness from the Fed.
Okay, so we've established the cost of money is high, pushing people towards safety. But that expensive capital isn't operating in a vacuum, right? It's being influenced by fears bubbling up from crypto's closest cousin, you could say, the stock market. That brings us to factor 2, The AI bubble concerns and the tech sell-off contagion, how connected are these two markets really?
Oh, this connection is structural. It's quite deep. The institutional investors who allocate money to high-growth tech stocks, the risk takers, they're often the same ones who fund crypto ventures.
Same pool of money, essentially.
Largely, yes. And the crypto market, particularly the altcoin space, maintains a high beta correlation with the NASDAQ composite.
Meaning when NASDAQ sells off,
Crypto often follows, but with amplified speed, like a leveraged bet on tech sentiment sometimes.
and the NASDAQ has been flashing some warning signs lately, hasn't it?
It has. The beginning of November saw the NASDAQ dropping 2%. More pointedly, market leaders, the big AI darlings like NVIDIA, saw declines of 4%.
Just profit taking or something more?
Probably a mix, but definitely fueled by concerns about peak AI valuation. The thinking goes, if institutional investors are spooked enough to sell core holdings in giants like NVIDIA, they certainly won't stick around in speculative, non-yielding assets like cryptocurrencies.
Right, crypto gets dumped first in that scenario.
Almost always. And this led Jeff May, the COO of BTSE, to issue a pretty profound warning. It's captured in our sources. He said, basically, if the tech sell-off deepens, Bitcoin could easily slip below $100,000, and altcoins may tumble even further.
So that fear alone is driving preemptive selling, people getting out before the potential tech wreck hits crypto fully.
Exactly. It adds another layer of downward pressure.
Okay, that sets the stage for a serious potential breakdown. Factor 3. This one feels less about finance and maybe more about psychology. The market is still deeply traumatized by that October 10th flash crash.
Trauma is exactly the right word. That event, just a few weeks ago, was monumental. Our sources identify it as the largest liquidation event in the history of crypto.
The largest ever.
Wow. In one single 24-hour period, triggered by, abrupt negative sentiment shifts, over $18 to $19 billion in leveraged positions were liquidated. Gone.
We talk about billions of dollars almost like abstract numbers sometimes, but that single event that represents hundreds of thousands of individual traders, maybe even smaller institutional players, just completely wiped out. How long does the memory of that kind of immediate financial pain typically last in the crypto market?
It lasts until there is a sustained period of stability and confidence, which we definitely have not seen yet.
Right.
The immediate effect is that the market's willingness to take any significant risk has just evaporated. We can track this really clearly with the Crypto Fear and Greed Index.
Yeah, what's that showing now?
Well, before the crash, it was comfortably in the greed zone, often hitting 60 to 70. As of today, November 7th, it has plummeted. It's down around 21 to 25.
21 to 25, that's extreme fear, isn't it?
Deep and extreme fear.
What does a score like 21 on the Fear and Greed Index actually translate to in terms of market behavior? What are people doing or not doing?
It means participants are highly reluctant to commit new capital. They're sitting on the sidelines. Those who are leveraged are rushing to deleverage or maybe lock in tiny profits if they can.
So very defensive.
Extremely. It means any positive news is kind of dismissed as just a temporary fluctuation, maybe a dead cat bounce. And any negative news, it's treated as confirmation of an impending disaster. This deep fear just chokes liquidity and prevents capital from flowing back in, almost regardless of how attractive current prices might look to a rational long-term investor.
Fear fuels selling. And factor 4 shows us exactly who might be accelerating the exit. The institutions. We're seeing a sustained institutional exodus, signaled pretty clearly by the Bitcoin ETF outflows.
The ETF outflows really are the smoking gun here. They show Wall Street is selling, plain and simple. In the days leading up to November 7th, our data recorded 6 consecutive days of withdrawals from Bitcoin ETFs.
6 straight days. How much are we talking?
Totaling a staggering $1.15 billion.
Billion with a B. Wow. Okay, this isn't small retail investors panic selling, though.
No, definitely not. This is large institutional funds actively reducing their crypto exposure.
Wait a minute, though. $1.15 billion in ETF outflows, that's huge. But Bitcoin is still trading around $100,000, which is an historically massive price point. Is this institutional exodus a sign that they've lost faith in crypto entirely? Or is it just, temporary profit taking after that big run up to the October high?
It's a likely combination, honestly. But the sustained nature, those 6 straight days, it suggests a more fundamental rotation based on that macro fear we talked about, the high interest rates, the tech worries.
So maybe taking profits, but then putting them somewhere safer, like bonds.
Exactly. They're taking those profits and not immediately reinvesting them back into crypto. They're moving into safer assets, reinforcing that point about high bond yields making safety attractive again.
Was there any sign of that stopping? Any inflows?
Well, we did see a tiny glimmer of stabilization right on November 7th. a small inflow of about $253 million.
Okay, so maybe a pause.
Maybe. But the data confirms that short-term retail buying, even if it picks up a bit, it simply cannot compensate for sustained multi-day institutional sell pressure exceeding $1 billion.
Yeah.
The big money flow is still outwards right now.
Okay. And finally, the mechanism that turns a small drop into a potential market disaster. The self-fulfilling prophecy, the leverage cascade.
Yes. This is probably the most dangerous aspect of crypto volatility, especially in downturns. In the first week of November alone, another $1.78 billion in leveraged positions were liquidated.
$1.78 billion just this month already. How many traders did that affect?
Over 441,000 traders. And the critical insight here from the data is that the vast majority of these were long positions.
People betting the price would go up.
Exactly. Traders who were betting on higher prices, but they were overextended, too much leverage.
Can you walk us through that cascade mechanic one more time, maybe with a quick illustration? How does it actually work?
Certainly. So imagine a massive bull run has happened, right? Traders get optimistic, maybe euphoric. They borrow heavily to buy Bitcoin, expecting to go even higher. They might be leveraged 10x, 20x, maybe even more.
Okay, high states.
Very. Then one of the macro factors we just discussed, say a surprise hawkish comment from the Fed or maybe a bad tech earnings report, causes just a small dip in Bitcoin's price, let's say 2%.
Which normally wouldn't be a huge deal for Bitcoin.
For an unleveraged holder, no. But because these positions are so highly leveraged, that tiny 2% drop is enough to trigger margin calls on millions, but potentially billions of dollars worth of positions.
And when a margin call happens, what's the immediate consequence?
The collateral must be sold immediately, often automatically by the exchange's systems to cover the loss. This forced selling pushes the price down further. Maybe now it's down 3% or 4%.
Ah, okay. And that lower price.
That drop triggers more margin calls on the next group of over-leveraged traders who had their liquidation point slightly lower. It becomes this vicious, self-reinforcing downward spiral. Forced sale, lower price, more forced sales, even lower price.
And how does this affect the altcoins, like our focus project, Pi Network?
Critically, altcoins like Pi Network, which have much, much shallower order books and far lower liquidity than Bitcoin, they experience drops that are often 2 or 3 times greater than Bitcoin's initial movement. Their collapse is disproportionately severe because there are fewer buyers to absorb the selling pressure. Okay, so with those 5 pillars of the crash established, let's now set the cold, hard baseline for the market as of right now, November 7th, 2025. This context is absolutely essential before we zoom in specifically on Pi.
Right, let's get the numbers. Give us the state of the foundational layer first. Bitcoin. Where is it?
Bitcoin, BTC, is currently trading in a very narrow and frankly tense range, somewhere between 100,549 times and $102,254 as we record this.
Just clinging on to that $100 K level.
Barely. It has endured a painful weekly change of negative 6.74%. And if we look back just a month to its peak, it's down nearly 19%.
19% from the high. When was that high?
October 7th, it hit $126,198. So a pretty steep fall from grace in just 1 month.
And the immediate focus for every investor, every trader, is that $100,000 level, right?
Absolutely. It is not just a number. It's a massive psychological anchor. If it breaks convincingly, the extreme fear we discussed in part 1 will likely escalate dramatically. It would confirm a deeper bear trend in many people's eyes.
Okay. And Ethereum, the major counterpart, the biggest altcoin.
Ethereum ETH is trading between $3,303 and $3,331. Now, while this weekly drop is sort of similar to Bitcoin's on a percentage basis, the internal movement was actually very aggressive.
How so?
ETH suffered a significant single-day drop of approximately 8.8% just between November 3rd and 4th, a really sharp fall.
Ouch. Any key levels broken?
Yes, and this is important. It has conclusively broken the key technical support level of $3,400.
And the significance of breaking $3,400?
It's a technical confirmation that even the most established, most liquid altcoins are in aggressive sell-off mode. It's not just the smaller caps feeling the pain.
Okay, so the scale of the crisis is clear. We lost that $1 trillion in market cap in about a month, plummeting the total from around $4.4 trillion down to roughly $3.4 trillion. Huge numbers. Now, let's introduce the specific data point that anchors the rest of our deep dive here, Pi Network.
Right. That brings us to the Pi Network, PI. As of now, Pi is currently trading between 0.2143 and 0.287 selens, so roughly 21.23 cents.
And its 7-day performance. How does it compare to Bitcoin's negative 6.7%?
It's significantly worse. Pi's 7-day performance is a harsh negative 13.35%.
Negative 13.35%. Wow. Okay, that immediately confirms our hypothesis then. Pi Network is falling significantly harder than Bitcoin, nearly double the pain of the market leader this week.
Precisely, it's bleeding much faster.
And its long-term performance. I mean, that paints an even more sobering picture, doesn't it? Illustrating its vulnerability even before this recent crash.
The long-term picture is, frankly, brutal. Pi Network is down a staggering 92.8% from its all-time high.
92.8% down. What was the high and when?
It hit 2.98 cents, almost $3, back in February 2025, now trading around 22 cents.
Okay, so this confirms that Pi Network isn't just a passive victim of the macro crash. It seems to have deep structural and project-specific flaws that are magnifying the sell pressure.
Absolutely. Which brings us neatly to the Pi Network paradox.
Right, the paradox. It's simple, isn't it? Why does Pi drop twice as hard as Bitcoin? You're saying it boils down to a combination of the general altcoin rule plus a series of, let's say, self-inflicted wounds unique to the Pi ecosystem itself.
That's a good way to put it. Let's start with the altcoin rule, just explained through basic volatility and liquidity concepts.
Okay.
As we sort of touched on earlier, the altcoin rule basically dictates that volatility is inversely proportional to liquidity. Less liquid assets swing harder. Look at the data comparison again. PI's weekly drop is negative 13.35%. Ethereum, more liquid, is around negative 9%. Bitcoin, most liquid, is negative 6.74%.
It's a classic flight to safety hierarchy playing out. Money moves from riskiest to safest within the crypto space itself.
Exactly. And we can see it in the numbers. Pi Network has a historical volatility measure of around 8.50%. Bitcoin's is much lower, around 3%. Pi just moves much more wildly, percentage-wise.
Why is Pi's volatility so much higher, though? Is it just the size difference compared to Bitcoin?
It's the size difference compounded by something called order book depth. Pi's 24-hour trading volume is minuscule. We're talking around $102 million.
Which sounds like a lot, but compared to Bitcoin.
It's nothing. Bitcoin's 24-hour volume is around $112 billion. Billion dollars with a B.
Okay, massive difference. So what does that mean in practical terms during a sell-off?
It means in a panic, if a large fund or even a group of smaller sellers decides to sell, say, $5 million worth of Bitcoin, the price barely moves. The market absorbs it easily. But if $5 million worth of Pi is sold,
It craters the price.
it can easily crash the price by 10% or more because there simply aren't enough buyers waiting on the other side of the trade in the order book to absorb that selling pressure without demanding a dramatic price reduction. This lack of liquidity guarantees amplified drops in panic scenarios. It's like trying to drain a bathtub through a straw versus a fire hose.
Okay, that's the generalized reason that applies to all smaller, less liquid altcoins. Now let's dive into the 4 specific structural flaws unique to Pi that seem to make its decline almost predictable, even worse than its peers. We have to start with the most measurable risk, right? The guaranteed token unlock pressure.
This is a massive, known structural flaw for PI. It's not speculation, it's scheduled. The unlock schedule creates a persistent and predictable supply shock. We know exactly when the supply will increase, and crucially, we know who's receiving those tokens.
Who's getting them?
Mostly early miners and testers, people who've been involved with the project for years, often contributing time and phone resources, not necessarily direct capital, and who've been waiting a long time for liquidity.
Okay, so there's pent-up desire to sell. What's the schedule look like right now for November?
For this month, November 2025, verified data shows 173 million PI tokens are scheduled to be released into circulation.
173 million tokens at the current price of, say, 22 cents. What kind of selling pressure does that represent in dollar terms?
That translates to approximately $38 million worth of potential selling pressure hitting the market just this month.
$38 million from holders who likely have a near zero cost basis, right? Since they mined it mostly.
Exactly. Their incentive to sell into any temporary rally or even just into the current depressed market just to realize some profit after years of waiting is extremely high. You could argue they are almost guaranteed sellers at some price point.
And this isn't just a one-off problem for November, is it? This problem is literally scheduled out.
Precisely. This self-inflicted issue, this constant supply increase, extends straight through the end of the year and beyond. December sees another significant unlock. 121 million PI are scheduled for release then.
Okay, 121 million. At current prices, that's roughly
Around $26 million in potential selling pressure for December.
So added up, just between November and December, we have nearly $65 million of known high incentive selling pressure hitting a market that, as you said, only has about $100 million in daily trading volume total.
Correct. It's a huge overhang. This predictable supply shock constantly suppresses the price because the current demand, already hampered by macro fears, cannot possibly absorb this constant influx of new tokens being sold off. It's like trying to fill a leaky bucket.
Okay, that's a major headwind. Moving on, factor two feels related to liquidity again, but more about access to it. The institutional liquidity barrier, specifically the absence of Pi network on major top-tier exchanges. This isn't just bad luck, is it? It seems like a more fundamental roadblock.
It really is the difference between being, say, a local neighborhood player versus a global financial asset. Pi Network is conspicuously absent from the world's most critical liquidity hubs. We're talking Binance, Coinbase, Kraken, Bybit.
The big names.
The ones where institutions and regulated funds tend to operate. Exactly. Those exchanges serve as the primary gateways for most institutional capital and regulated retail funds, particularly in the West. Pi is currently only listed on what you might call secondary or less regulated exchanges like OKX, Gate.io, Bidget, and MEXC.
Why is this a structural barrier, though, rather than just, a temporary inconvenience they could fix by applying and getting listed? What's stopping them?
Because the top-tier exchanges enforce extremely stringent regulatory and compliance hurdles. They have rigorous Know Your Customer, KYC, and anti-money laundering, AML standards. Plus, they conduct deep due diligence on a project's tokenomics, its distribution, its level of genuine decentralization, and its regulatory clarity.
And the implication is Pi might not meet those standards currently.
That's the strong implication, yes. The consequences of failing to meet these standards are severe and multifaceted. First, it caps the 24-hour trading volume to that tiny $102 million we mentioned. Second, and crucially, it restricts the primary retail investor base mainly to Asian and developing markets, limiting its global reach.
And third, most damagingly from a price perspective,
It guarantees the complete and total absence of institutional Wall Street demand. No large fund, no regulated entity, no pension fund, no ETF provider can legally or compliantly touch an asset that isn't listed on a compliant Tier 1 exchange that meets their due diligence requirements. It's a non-starter for them.
Okay, so we have an illiquid asset facing constant selling pressure from unlocks and locked out of the major leagues. Yet, paradoxically, it still seems to follow the market leader down. That brings us to factor three, this high correlation with Bitcoin, but without the institutional support Bitcoin enjoys.
Yes, it's a strange situation. Pi Network displays a surprisingly high correlation with Bitcoin's price movements. Generally, that correlation sits in the 0.85 to 0.90 range.
Which is very high, almost moving in lockstep.
Extremely high. It means that for every dollar Bitcoin moves up or down, Pi is designed, statistically speaking, to follow its direction really closely. It is, in technical terms, a high beta play on BTC.
Now, normally, in a bull market, having a high beta asset that follows Bitcoin's moves, maybe even amplifies them, sounds fantastic. Why is this correlation actually a significant drawback in the current negative environment?
It's basically the worst of both worlds right now. When the macro market turns sour, like it has, Pi faithfully copies the bear trend. It drops hard because of its high correlation. It follows Bitcoin off the cliff.
Okay, downside correlation is strong. What about the upside?
And here is the critical drawback. When the market eventually begins to recover, whenever that might be, PI is likely to grow slower than BTC.
Slower. Why? If it's highly correlated.
Because Bitcoin now benefits from billions of dollars in institutional buy pressure flowing in via those very ETFs we discussed earlier. That provides a floor and buying power during recoveries. Pi, locked out of those top exchanges and inaccessible to institutions, lacks any mechanism to attract that crucial institutional recovery capital.
Ah, I see. So it gets dragged down just as hard, but doesn't get lifted up as much during a recovery because the big money can't buy it easily.
Precisely. The net result is an asset that offers dramatically higher volatility and risk on the downside, but demonstrably lower recovery upside relative to its correlation partner, Bitcoin. It's a structurally disadvantaged beta play in the current market setup.
Okay, that makes sense. And finally, let's address let's call it the elephant in the room, something that seems to have caused internal structural damage within the Pi community itself, the GCV hoax and the resulting community demoralization. What is GCV?
Yeah, this speaks directly to the project's reputation and a breakdown in its internal pricing mechanism, or at least expectations. GCV stands for Global Consensus Value.
Global consensus value. Okay.
This refers to an internal, largely community-driven narrative, often amplified significantly on social media platforms, that assigns an extremely unrealistic expectation for the token's future price.
How unrealistic are we talking?
Sometimes cited as high as $314,159 per token, based on, the mathematical constant pi.
$314,000 per token. When the market price is currently 22 cents, that is clearly detached from reality. How does this fantasy valuation actually hurt the project in tangible ways?
It fundamentally splits the community and destroys any semblance of rational price discovery within its user base. You have the committed believers, the pioneers, who cling to this GCV fantasy. They refuse to sell at the current market price, maybe even refuse to use the token for commerce at market rates, because they genuinely believe they're holding assets worth hundreds of thousands of dollars and selling them for pennies.
So they hoard, essentially, based on an unrealistic hope.
Yes. And simultaneously, you have the skeptics, both inside and outside the community. Seeing this unrealistic expectation being promoted so heavily, they sell out of frustration and disbelief. They take the rational exit, selling at the market price, because they see no connection between the GCV narrative and the economic reality.
So the market for Pi ends up being dominated by panic sellers during downturns, plus the forced sellers from the unlock schedule, and the potential buyers who might see value at 20 cents are scared off or drowned out by the GCV noise, while the GCV believers refuse to sell or buy at realistic prices.
Exactly. It creates a dysfunctional internal market dynamic,
Mhm.
and externally. This widespread belief in, frankly, impossible price targets acts as a massive red flag for any sophisticated external or informed investor looking at Pi Network.
How so?
They see a community, or at least a very vocal part of it, seemingly unwilling to engage with market reality. This signals that the project potentially lacks the maturity, the grounding, and maybe the transparency required for serious investment consideration. It damages credibility enormously.
Okay.
So with those significant macro and micro pressures now clearly defined, let's turn to the technical indicators for Pi Network specifically. As of today, November 7th, we need to define the critical lines in the sand, technically speaking, for the short-term future.
Right. What does the current price action on the chart tell us about the immediate supply and demand dynamics? Where's the battle being fought?
Pi is currently trading in a pretty tight consolidation range, basically stuck between 21 cents and 26 cents. It's been chopping around in there. The key battleground, though, is the support level down at 21 cents.
Solid of lowering 1 cent. Why is that level absolutely critical right now?
It's critical because it coincides with two major technical metrics that traders watch very closely. First, it lines up with the 0.618 Fibonacci retracement level, calculated from a previous significant low to high move.
Okay, the 61.8 fib level. And for other listeners who maybe don't live and breathe technical analysis, why is that specific Fibonacci level, the 0.618, considered so important?
The 0.618, often referred to as the golden ratio in technical analysis, is typically viewed as the last major line of defense in what might be considered a healthy technical correction or pullback.
The last stop before things get really bad.
Essentially, yes. If a price falls decisively below the 0.618 level, it often signals a significant capitulation by the bulls. It suggests the current downtrend is deeply entrenched and is likely heading toward a retest of the absolute lows, or potentially even new lows. So a clean break below $2.21 would be a textbook technical sign of severe weakness for Pi.
What was the other technical factor at 70.21 cents?
It also aligns with the value area low, which is derived from volume-weighted trading data over a specific period. It indicates the bottom edge of where the majority of trading volume has occurred recently. Falling below that suggests the market is rejecting the recent price range entirely.
Okay, 7.21 cents is crucial support. What about the targets on the upside? If it bounces, where does it need to get back above?
Immediate resistance is probably light, maybe around 25 cents. But the really key level for any attempted bullish reversal the level bulls need to reclaim is $2.26. That's the top of the current consolidation range.
And above $2.26. Are there other resistance levels looming?
Yes, the longer-term moving averages are sitting significantly higher, acting as major obstacles. The 50-day exponential moving average, EMA, is currently around $0.27, so just above that $0.26 resistance, ready to cap any initial breakout attempts.
And the big one, the 200-day.
The 200-day simple moving average, SMA, which many traders use to define the long-term trend.
Hmm.
That's far away. It's way up at approximately 78 cents.
Wow. The distance between the current price, around $0.22, and the 200-day SMA really confirms just how deeply entrenched Pi is in a long-term bear trend.
Absolutely. It's significantly below its long-term average price.
And what about volume? We mentioned the low daily volume earlier. Is anyone showing up to buy this dip near $0.21? Any signs of accumulation?
No,
No.
not really. Trading volume remains weak, hovering around that $102 million 24-hour mark we discussed. This indicates weak buying pressure and a general lack of enthusiastic market interest at these levels. It confirms that the risk-averse behavior we saw reflected in the Fear and Greed Index is holding true specifically for Pi investors, too. People aren't rushing in.
Okay. Given this pretty dire technical picture, combined with the severe macro headwinds and the absolute certainty of that upcoming unlock schedule, let's try and put some probabilities on the potential paths forward for Pi over the next, say, month or two. What are the likely scenarios?
Right, this is always tricky, but based on all the factors combined, we can outline a probability-weighted outlook. Let's break it down into three main scenarios.
Okay, what's scenario one?
The most likely.
Scenario one, bearish continuation. We're assigning this a 55% probability. This is our most likely outcome, primarily because the known headwinds, specifically the hawkish Fed keeping rates high and those massive imminent token unlocks, are just so overwhelming right now.
What would trigger this scenario to fully play out?
This scenario is likely triggered if Bitcoin fails to hold that crucial $100,000 psychological floor and drops convincingly below, say, $95,000. Combine that with the 173 million PI tokens unlocking this month, creating that massive guaranteed sell pressure we talked about. The combination would likely be too much for Pi to handle. And where does that level of pressure push the price of Pi in the near term under this scenario?
The November target in this bearish continuation scenario would likely be down in the $1.17 to $1.20 range.
$1.17 to $1.20. That's basically a retest of the previous all-time low, isn't it? The one set during the October flash crash.
Exactly, a retest of the lows. And if the macro environment remains hostile into December, with another unlock coming, the targets could drop even further, potentially to $15.18.
Which means a new all-time low would be a strong possibility.
Yes, a distinct possibility under this scenario. The primary catalysts driving this are continued Fed hawkishness keeping investors risk off, and that relentless unlock schedule flooding a demand-starved market with new supply.
Okay, 55% chance of more pain. That leaves 45% for other outcomes. What would need to happen to just stabilize the price, even if it doesn't rally dramatically? Scenario two.
Scenario two, consolidation and slow recovery. We're giving this a 35% probability. This is less likely than further downside, but still plausible. It requires two major shifts to happen.
What are they?
Externally, the heavy institutional selling of Bitcoin must stop. We'd need to see those EPF outflows cease and maybe even reverse, with inflows returning. That would signal the broader market might have found at least a temporary bottom.
Okay, external stability needed. And internally for Pi.
Internally, the Pi community and the market makers would need to somehow successfully absorb the massive November token unlock without triggering an outright panic sell-off. Demand would have to materialize to soak up that $38 million in potential selling.
That sounds like a big ask given the current volume. What price action would we expect to see if this consolidation scenario plays out?
In this scenario, we'd likely see sideways movement through November. Pi might just chop around in that $1.22 to 24-cent range, basically holding the current low ground. If some positive catalysts emerge in December, we could see slow growth, potentially reaching the $1.22 to 22 cent to 28 area. Still well below the major averages, but stable.
Are there any potential internal catalysts the Pi development team might be hoping to leverage to achieve this stabilization? Anything on their roadmap?
Yes. There are a couple of key development milestones mentioned in the sources. The big one is the potential successful launch of Protocol 23 mainnet. This is important because it's supposed to finally introduce smart contracts and bring real utility to the network beyond just basic transfers.
Okay, smart contracts could theoretically drive some demand if applications get built. What else?
The other is the planned public launch of the PiDux, their own decentralized exchange, which is reportedly scheduled for December. If that launches smoothly and sees significant adoption, it could facilitate necessary internal liquidity and maybe reduce reliance on those secondary centralized exchanges.
So successful tech rollouts could help absorb the unlocks, maybe? 35% chance. That leaves the dream scenario, the one that would defy all the current negative data, scenario three.
Scenario three, bullish reversal. We have to assign this a low probability given the current climate, 10% probability.
Only 10%. Why so low? What would it take?
This is highly improbable because it likely requires a black swan type event, something unexpected and overwhelmingly positive. Either a massive, unexpected positive catalyst for the entire crypto market,
Like what?
like Bitcoin suddenly catching a huge bid, maybe fueled by unexpected positive geopolitical news or some major institutional adoption announcement, and breaking to a new all-time high, well above $130,000. That kind of rising tide could lift all boats, even leaky ones.
Or maybe a surprise from the Fed.
Or a massive dovish surprise from the Fed. Not just stopping hikes, but an immediate unexpected rate cut. That would likely ignite risk assets across the board.
Unlikely, but possible. Or could a Pi-specific game changer trigger this, like, say, that major exchange listing they desperately need?
Precisely. A surprise listing on Binance or Coinbase would be a massive catalyst. However, given the ongoing regulatory concerns we discussed, the lack of clarity around Pi's token distribution, and the generally risk-off environment, a Tier 1 listing seems incredibly unlikely under the current headwinds. The exchanges are probably tightening standards, not loosening them.
But if this 10% scenario did happen, where could the price go?
In this rare bullish reversal event, November targets could potentially shoot up towards $0 and $30.40, finally breaking above those near-term moving averages. December could even see a push towards $0.45 to $0.60, getting closer to that 200-day SMA. But again, the probability is extremely low, heavily constrained by those persistent, guaranteed supply shocks from the unlocks, which would likely dampen even a strong rally.
Okay, this analysis provides some really necessary context. We've got the macro gravity pulling everything down, and then these Pi-specific anchors making it sink faster and struggle to rise. The question now, for you, the listener, is how to apply this knowledge. What do you actually do? Let's start with advice for the short-term traders, the people who are comfortable navigating this kind of high-risk volatility we've just detailed.
Right. For active short-term traders, the technical indicators combined with the macro picture and the unlocks strongly favor a bearish strategy right now, or at least extreme caution.
So what should they be watching?
You absolutely must monitor that daily 21 support level vigilantly. If that crucial support breaks convincingly, especially on increased volume, aggressive short opportunities might emerge. The logical target then becomes that datal 17 centria, the prior low.
Given the leverage cascade risks we discussed earlier, what are the critical safety warnings for anyone trading Pi right now?
Number 1, avoid leveraged long positions at all costs. Seriously. The risk of liquidation is astronomically high in this environment, as we saw with that $1.78 billion cascade just recently. Don't try to catch a falling knife with leverage.
Okay, no leverage longs. What else?
Second, do not let fear of missing out, FOMO, trick you into buying during small relief rallies. If the price suddenly jumps 5% or 10% on low volume, it is highly likely just a temporary pump, maybe driven by short covering, that will be immediately sold off by those unlock holders or others waiting for any exit liquidity. Be patient.
So if someone is looking to potentially enter a long position, maybe betting on that consolidation scenario or a bounce, what should they wait for as confirmation? What's a potentially safer entry signal?
Confirmation is everything in a market like this. You need to wait for at least 2 conditions to be met simultaneously before considering a long.
Condition 1.
First, Pi must successfully break out above the key resistance level at $0.26, and crucially, it needs to do so on demonstrably high trading volume. High volume confirms real buying interest behind the move.
Okay, breakout above 0.26 cents on volume. Condition 2.
Second, this Pi breakout needs to happen while Bitcoin has stabilized and is holding comfortably above $105,000. This signals that the broader institutional selling pressure might have genuinely abated. You need the market leader's support.
Right, don't fight the macro trend. If both those conditions are met, Pi above $0.26 on volume and BTC stable above 105K, then what?
Then and only then do targets higher up, maybe towards Dearies and 35s or even Deer on 40 cents, start to become technically viable again. But patience and confirmation are key.
Okay, that's for the short-term traders. Now let's pivot to the long-term holders, the HODL strategy crowd. These are the investors who perhaps believe in the project's ultimate vision, maybe looking out towards 2026 or 2027. What's the advice for them?
For the committed long-term believer, a deep bear market like this is often viewed as an opportunity for accumulation, assuming their fundamental belief hasn't changed. The most sensible strategy here is usually dollar cost averaging or DCA.
Explain DCA quickly again.
It just means allocating small, regular amounts of money, say $50 or $100, whatever fits your budget, to buy Pi at set intervals, maybe weekly or monthly, regardless of the short-term price fluctuations.
Just you buy whether it's 25 cents or 15 cents.
Exactly. By spreading your buys out over time, you eliminate the huge risk of trying to time the absolute bottom, which is nearly impossible. You avoid trying to catch that falling knife.
Yeah.
And importantly, you average down your overall cost basis over time.
But even long-term holders need some risk management, right? Especially considering those unique structural risks we talked about, like the constant unlocks continuing for a long time.
Absolutely. Blind faith isn't a strategy. If PI does manage to achieve a temporary rally, perhaps it bounces off support, or maybe gets a boost, reaching that $30 to 35 cents area, potentially driven by a successful Protocol 23 launch later this year. Even long-term holders should consider taking some risk off the table.
Like selling a portion.
Yeah, maybe selling a partial amount, say 20% to 20% of their holdings. This allows you to recoup some of your initial investment or lock in some profit, effectively de-risking your overall position.
So you secure some gains, but still keep skin in the game for the long run.
Exactly. It leaves the majority of your tokens in play for that potential major breakout much further down the road, like if they do eventually secure that elusive major exchange listing.
Yeah.
But holders must remain acutely aware. Those token unlocks are scheduled to continue well into 2026. Our sources indicate over 400 million more tokens are expected to be unlocked just by the end of 2025 alone.
400 million by year end, on top of what's already out there. That is immense sustained supply pressure that isn't going away anytime soon.
It's a massive structural headwind that cannot be ignored, even by long-term bulls.
Okay, finally, let's look at the calendar. What are the key market events and project-specific dates everyone following Pi, or the broader market, needs to track immediately in November and December?
All right, November is the immediate focus. Lots happening. Firstly, as we've hammered home, that massive 173 million PI token unlock is imminent this month. We expect this to have a strong short-term bearish impact due to that guaranteed selling pressure.
Okay, unlock pressure incoming. What else?
Secondly, the Fed meeting on November 12th, 13th is a critical date for the entire crypto market, not just Pi. Any change in Jerome Powell's tone regarding future rate policy could significantly shift that macrogravity we've been discussing.
So watch the Fed language closely. Anything Pi-specific in November besides the unlock?
Yes, the possible launch of the Protocol 23 mainnet. The timing isn't certain, but it's expected potentially this month. If it launches successfully and smoothly introduces working smart contracts, that would be a much-needed internal utility boost for the project. Bullish if it works.
Okay, and wrapping up the year in December, what's on the horizon?
December brings kind of a twin threat and opportunity for Pi. The threat is another significant token unlock. 121 million PI tokens scheduled for release, maintaining that bearish supply pressure into year-end.
Another $26 million or so hitting the market?
Yeah.
And the opportunity.
The opportunity is the planned public launch of the PiDX. If this decentralized exchange launches successfully and sees high adoption from the community, it would be a crucial positive indicator of the network's internal health and its ability to generate its own liquidity. That's potentially bullish if it gains traction.
And the Fed meets again in December too, right?
Yes, the final Fed meeting of the year is December 17th, 18th. That meeting will confirm whether the current market expectation, around 69% probability of no rate cut, holds true for the end of 2025. Still unlikely we get a cut, but the market will be watching intently. Hashtag tag outro.
Wow. This has been an incredibly detailed look at a market and a specific project under really extreme duress. To summarize the core analysis here, Pi Network's disproportionate underperformance, falling twice as hard as Bitcoin this week, seems to be due to a punishing dual problem.
That's right. It is squarely caught between those overwhelming external forces, that macrogravity created by a hawkish Fed, the contagion fears from the tech sell-off, and the clear signs of institutional exodus from risk assets.
And severe, arguably self-inflicted structural project risks that are unique to Pi.
Exactly. Those structural risks being, number one, the guaranteed and predictable selling pressure from the ongoing token unlocks. Number two, the cripplingly low liquidity and lack of institutional access due to its absence from major compliant exchanges. And number three, the lasting reputational damage and community division caused by things like the GCV hoax.
All of which collectively ensure that Pi's drops are amplified far beyond what even Bitcoin is experiencing in this downturn.
Now, the source material does show Pi Network has internal development catalysts coming up, the DEX launch, Protocol 23 bringing smart contracts, things that could eventually provide real utility and maybe drive some demand internally.
But There's a big but, isn't there?
There is. Given the current analysis, especially that 55% probability we assign to a deeper bear market continuation, the critical question for you, as an investor looking at Pi, is this. Can any project-specific launch, no matter how successful internally, realistically overcome $65 million in known, guaranteed selling pressure hitting the market just from the November and December unlocks, especially if Bitcoin fails to hold the crucial $100,000 floor?
It really is the ultimate test, isn't it? A test of whether internal project strength, like new tech releases, can actually counter overwhelming external financial gravity and built-in supply pressure. That is the challenging question we leave you with today. Thanks for diving deep with us.